Silver alert. If you own silver, the market is warning you. Something unusual is happening in the silver market right now. Not the kind of unusual that makes headlines, not the kind that gets discussed on mainstream financial television, the kind that happens quietly, in the data, in the positioning, in the mechanics beneath the surface, while most investors are looking somewhere else entirely. Here is the contradiction that should stop every silver investor cold. Industrial demand for silver is at record highs. The global energy transition is consuming silver at a pace the world has never seen before. Solar panels, electric vehicles, artificial intelligence infrastructure, defense systems. Every one of these industries runs on silver, and every one of them is accelerating. And yet, silver is not behaving the way you would expect. The price is not reflecting what the fundamentals are screaming, which means one of two things is true. Either the market knows something silver investors don't, or silver investors are about to be proven right in a very dramatic way. By the end of this video, you will understand exactly what signal the silver market is sending right now, and what it has historically meant for investors who paid attention. Stay with me, because the deeper you go into this story, the more important it becomes. Section 1. The surface story. Let's start with what most people see when they look at silver. They see a metal, a commodity, something that goes up when inflation rises and comes down when the dollar strengthens. A smaller, more volatile version of gold, a hedge, a speculation, a shiny asset for people who distrust central banks. That is the surface story, and it is incomplete in ways that matter enormously, because silver is not simply a commodity. Silver is the only asset on Earth that simultaneously functions as a monetary metal, an industrial input, and a strategic resource. No other asset on the planet carries all three of those roles at once, and right now, all three of those roles are being activated at the same time by forces that have been building for years. But here is what most investors miss entirely. The silver market is structured in a way that creates enormous tension between the paper price, the price you see on your screen, and the physical reality of supply and demand. That tension has existed for decades, but the forces pushing against that structure are larger today than they have ever been. And when that kind of tension builds long enough, it doesn't release slowly, it releases all at once. We'll come back to exactly what that means in a moment. First, let's understand the warning signal the market is sending right now, because it is hiding in plain sight. Section 2. The warning signal. The signal is this. Silver is dramatically underperforming gold. The gold-silver ratio, the number of ounces of silver required to buy 1 ounce of gold, is sitting at historically elevated levels. At the time of this analysis, that ratio is well above 80. In some recent periods, it has pushed toward 90. To understand why that is a warning signal, you need to understand what this ratio has historically meant. Over the past century, the long-term average gold-silver ratio has hovered around 50 to 60. In ancient monetary systems, it was closer to 15. When the ratio rises dramatically above historical norms, one of two things has historically happened. Either gold falls back towards silver, or silver rises dramatically toward gold. In precious metals bull markets, real bull markets, where monetary stress is high and institutional money begins flowing in, silver does not simply keep pace with gold. Silver historically outperforms gold by a wide margin during the most intense phases of a bull cycle. In 1979 and 1980, when gold went from $200 to over $800, silver went from $5 to nearly $50. Gold roughly quadrupled, silver multiplied by 10. In 2010 and 2011, gold rose approximately 70% over an 18-month period. Silver rose over 170%. Every time the gold-silver ratio has been this elevated during a period of monetary stress and then normalized, silver has moved faster, further, and harder than almost any other asset on Earth. So when the ratio is sitting where it is today, that is the market telling you something. But that is only the first layer of the signal, because something else is happening beneath the surface. Something that connects to a structural problem in the silver market that most retail investors have never heard of. Section 3. The structural problem. To understand the deeper warning, you need to understand how silver is actually priced. Most people assume the silver price is set by supply and demand. Physical silver is bought and sold. and the market finds a price that balances those forces. Simple, logical, reasonable. That is not how it works. The silver price is primarily determined by the futures market, specifically the COMEX exchange in New York. And on the COMEX, the overwhelming majority of silver contracts that are traded are never intended to result in physical delivery. They are paper contracts, financial instruments, positions opened and closed without a single ounce of silver ever changing hands. For every ounce of physical silver that exists in COMEX registered vaults, there are estimates suggesting that somewhere between 100 and 400 paper ounces have been written against it. Read that again. For every real ounce, as many as 400 paper claims on that same ounce. This system has functioned for decades because the vast majority of futures traders never actually want physical silver. They want exposure to the price. They want to hedge. They want to speculate. And as long as everyone plays by those rules, as long as no one actually demands delivery, the system holds. But here is what is changing. Physical silver is beginning to be pulled out of the system at an accelerating rate. In recent years, demand for physical silver, not paper claims, but actual metal, has surged. The Silver Institute, which tracks global supply and demand data, has reported consecutive years of physical supply deficits. More silver is being consumed by industry, investment, and central bank accumulation than is being mined and recycled to replace it. When a market running on paper leverage begins experiencing persistent physical shortages, that is a structural stress signal. And there is a geographic dimension to this story that makes it even more significant. Section 4. The Shanghai Factor. While Western paper markets have largely controlled the silver price for decades, something has been shifting in the East. China has been building physical silver infrastructure for years. The Shanghai Futures Exchange, the SHFE, trades physically settled silver contracts, not paper, physical. And in recent years, the SHFE has seen extraordinary volume growth as Chinese industrial buyers and investors have been accumulating physical silver at a pace that has drawn attention from market analysts globally. At various points in recent history, a spread has emerged between the Shanghai silver price and the COMEX silver price. Shanghai physical silver has traded at a premium to New York paper silver, sometimes a meaningful premium. That spread is a signal. When physical silver in one of the world's largest industrial economies is trading above the theoretical paper price set in New York, the market is telling you that physical silver is worth more than the paper price suggests. This is not a conspiracy theory. This is basic market mechanics. When real buyers competing for real metal are willing to pay more than the futures price, they're telling you something about the true clearing price of physical silver. Now combine that with this. China is the world's largest consumer of silver for industrial purposes. Solar panel manufacturing alone consumes an enormous and growing quantity of silver. China's government has committed to massive expansions in solar capacity over the coming decade. The country that is pricing physical silver at a premium to the Western paper price is also the country with the largest and fastest growing industrial demand for silver in human history. And the world's silver miners cannot simply turn on a faucet to meet that demand. Section 5. The supply problem. Here is a fact about silver mining that most investors overlook completely. Approximately 70 to 75% of silver produced globally is not mined as a primary product. It is produced as a byproduct of copper, zinc, lead, and gold mining operations, which means the supply of silver is not primarily driven by the silver price. It is driven by the economics of other metals. This creates a structural rigidity in silver supply that has profound implications. When the silver price rises, you cannot simply build more silver mines to meet the demand. There are very few primary silver deposits of meaningful scale left in the world that are economically viable to develop. The ones that exist face permitting timelines, environmental reviews, capital requirements, and geopolitical risks that often stretch development timelines to a decade or more. Meanwhile, byproduct silver supply from base metal mining is constrained by demand for those base metals, not by silver prices. So when industrial demand for silver begins to overwhelm supply, as the data strongly suggests is already happening, the price mechanism is the only adjustment variable available. And price adjustment, when it comes after a prolonged deficit period in a market leveraged with paper instruments, tends not to be gradual. The Silver Institute's data has shown consecutive annual deficits, physical demand exceeding total supply in recent years. The installed base of deficit is growing, and yet the paper price has remained suppressed relative to what supply and demand fundamentals would theoretically suggest. This is the core tension in the silver market today. Something has to give. But there is one more layer to this story, and it may be the most important one for understanding the timing of what comes next. Section 6. The macro trigger. Silver does not move in isolation. It never has. The timing of silver's most dramatic price movements in history has consistently coincided with specific macroeconomic conditions. Understanding those conditions is essential to understanding the potential trigger for what the market may currently be warning about. The conditions that have historically preceded silver's most explosive moves include a weakening US dollar, elevated or rising inflation, a Federal Reserve that is cutting interest rates or signaling monetary easing, declining real yields, meaning the return on bonds after adjusting for inflation, rising geopolitical stress, and increasing institutional and sovereign interest in hard assets as alternatives to paper currency systems. Look at the current macroeconomic environment. The Federal Reserve has been navigating one of the most complex policy environments in decades. Inflation has proven stickier and more persistent than the Fed initially projected. The US national debt has crossed levels that would have been considered impossible a generation ago, and it continues to grow at a pace that raises serious long-term questions about dollar credibility. The BRICS coalition, Brazil, Russia, India, China, South Africa, and their expanding membership, has been openly discussing alternatives to the dollar-based settlement system for international trade. Central banks globally have been accumulating gold at the fastest pace since the 1960s. When central banks, the institutions that manage national monetary systems, decide that they want more gold, they are making an institutional statement about their confidence in paper currency systems. And gold and silver have historically moved together during periods of monetary stress, with silver amplifying gold's movements in both directions. If the macro conditions that are currently developing continue to build, the combination of a paper-silver market under structural stress, persistent physical supply deficits, rising industrial demand, Eastern physical buying, and macroeconomic pressure on fiat currency systems creates a setup that analysts who study these cycles describe as historically rare. But history also teaches us something important about rare setups. Section 7. Historical parallels. Let's go back to 1979. In 1979, the United States was facing a crisis of confidence. Inflation was running at double digits. The dollar was under severe pressure. The Federal Reserve had lost credibility. Geopolitical tension in the Middle East had sent energy prices surging, and the monetary system that had governed global finance since Bretton Woods had already been torn apart when Nixon closed the gold window in 1971, leaving the dollar untethered from any hard asset anchor. In that environment, silver went from approximately $5 per ounce to nearly $50 per ounce in roughly 18 months, a 10-to-1 move. Now, the circumstances are not identical to today. They never are. History rhymes, it does not repeat with precision, but the structural parallels deserve careful consideration. A dollar system under pressure, persistent inflation, Federal Reserve credibility questions, geopolitical stress, rising interest in hard assets, a silver market that had been suppressed for years, and a physical market beginning to disconnect from the paper price. In 1979, when that disconnection resolved, it resolved violently and rapidly. Consider also 2010 and 2011. Following the global financial crisis, unprecedented monetary stimulus from central banks globally, zero interest rates, quantitative easing, trillions in liquidity injection, sent silver from approximately $17 per ounce in September 2010 to nearly $50 per ounce by April 2011. That was a move of nearly 200% in roughly 7 months. Both of those episodes had preconditions that built over years before the actual price movement occurred. The preconditions visible in the silver market today have also been building for years. The question is not whether the tension resolves. Structural tensions in markets always resolve eventually. The question is when and what the catalyst is. Section 8. What to watch. So what are the signals to watch? The indicators that would suggest the tension is beginning to release. First, the gold-silver ratio. If the ratio begins moving meaningfully lower from its current elevated levels, that historically signals silver beginning its catch-up phase. A ratio declining from 85 towards 70, then towards 60, would be an important signal for the precious metals complex. Second, COMEX registered silver inventories. If physical silver stocks in COMEX vaults decline meaningfully, particularly if the rate of decline accelerates, that signals that physical demand is beginning to strain the paper system in ways that cannot be managed indefinitely. Third, the Shanghai premium. If the spread between Shanghai physical silver prices and COMEX paper prices widens materially, Eastern buyers are signaling that the paper price has become increasingly disconnected from physical reality. Fourth, Federal Reserve policy signaling. If the Fed pivots toward rate cuts, real rate cuts, not just pauses, declining real yields historically have been one of the most reliable catalysts for precious metals performance. Gold moves first, silver amplifies. Fifth, industrial demand data. Solar panel installations, EV production numbers, AI data center build-out, and defense procurement all consume silver. If those numbers continue to accelerate while mine supply remains constrained, the physical deficit compounds. None of these signals in isolation is necessarily a trigger, but when multiple signals align simultaneously, that is historically when the paper market's price discovery mechanism can no longer suppress the physical reality of supply and demand. Section 9. What this means for silver investors. If you already own silver, physical silver, silver ETFs, silver mining equities, or silver streaming companies, the market is not necessarily telling you that you are wrong. It may be telling you that you are early. In markets with structural tensions of this magnitude, being early and being wrong can feel identical for extended periods of time. That is the psychological challenge of holding a position that is fundamentally supported but hasn't yet moved. The investors who captured the full magnitude of silver's 2010 to 2011 move, the 200% gain in 7 months, were people who had accumulated their positions during the years of suppression before that move began. Many of them had held through periods of frustration, underperformance, and doubt. The market does not reward the people who arrive after the move. It rewards the people who understood the structural setup before the move and had the discipline to hold through the noise. If the analysis in this video is directionally correct and current conditions continue to develop, then the warning the silver market is sending today is not a warning to sell. It may be a warning to pay very close attention. One possible scenario, if conditions unfold as the structural data suggests, silver catches up to gold, the gold-silver ratio normalizes toward historical averages, and the physical supply deficit forces the paper price higher to attract the additional supply the market requires. Another scenario, macro conditions stabilize, the Fed manages a soft landing, inflation expectations normalize, and silver trades sideways or lower while industrial demand quietly continues to build. The honest answer is that no one knows with certainty which scenario plays out or when. What the data does suggest is that the structural setup in silver is as compelling as it has been at any point in the past several decades, and the investors who understand why that is are not reacting to headlines. They are watching the signals. The bigger picture. Let's come back to where we started, the contradiction. Industrial demand at record highs, physical supply in deficit, Eastern buyers paying a premium for real metal, the gold-silver ratio at historically elevated levels, a paper market carrying leverage that would be impossible to back with physical metal if a fraction of contract holders demanded delivery, and a price that has not yet reflected any of this. That is the warning the silver market is sending, not through headlines, not through mainstream financial commentary, through the data, through the mechanics, through the structural reality of a market where paper claims have increasingly diverged from physical truth. The greatest moves in commodity history, the moves that transformed patient investors into people who speak about silver the way others speak about buying Amazon in 2002 or Bitcoin in 2013, did not announce themselves in advance on CNBC. They announced themselves in exactly this kind of quiet, structural, data-driven setup. Whether this moment becomes one of those moments, only time will tell. But if you own silver and you've been wondering why the price doesn't reflect what you know about the fundamentals, the market isn't ignoring the story. It may just be loading the spring.